Apna Course. Get smart, get ahead.
The next topic are trading strategies involving options, very important for your exams. So let's take it up. The first strategy, covered call. Now what's a covered call strategy? Let me try and sum it up. Effectively, a covered call strategy is when I have a long position on the underlying and I go and short the call on the underlying, right? So you are long the underlying, you are short the call. So let's look at it as the slide says. An option strategy where an investor holds a long position in the asset and writes a call option on the same asset in an attempt to generate increased income from the asset. Clearly, it's almost like a lease rental strategy. That's what it is termed as. I own the asset and I try to generate regular income from it. And how do I do it? By writing call options on that asset. Investors view that volatility of the asset is neutral in short term. So clearly, if I don't see the asset going up a lot, then I would be quite comfortable selling call options on it. Do remember, you don't expect the asset to be very volatile on either sides, because if it were to be, if you fear that there's going to be a massive decline in the asset value, even by selling a call, the kind of premium that you get might not be good enough for you to make up for your erosion in the value of the asset. So clearly, this kind of a strategy helps you stay afloat and make good returns when the asset is very limitedly volatile. And this is how the payoff is going to look like. Let's look at how do we finally arrive at this payoff. Complicated as it may seem like, let's take it step by step. I own the underlying. If I own the underlying, this is the kind of payoff that the underlying would represent. This is the price at which I had gone long the underlying. I make money when the underlying value goes up, and I lose money when the underlying value goes down. So this is what my payoff for the underlying is going to be. Now, if I sell a call option on the underlying, let's say with a certain strike price, let's say this is a strike price. This is the strike price at which I sell the call option on the underlying. If I sell a call option on the underlying, my payoff is going to be similar to that of the writer of the call option. So this is how it's going to be, correct? So now try and integrate these two graphs. Well, beyond this point, this goes down. Beyond this point, this is going up. So when I add up these two, I get a line parallel to the x-axis. So my graph is going to look like this. So beyond a point, I'm only able to make I'm only able to make a certain limited amount of income, which gets capped at this point of time. So let's say I bought this stock at 100. I sold a call option with the strike price 110. Well, my gains are limited to 10 rupees or $10, right? Now, you would say, well, you have forgotten the premium that you get when you write the call options. Let's say by selling a 110 call option, I received a premium of 5 rupees or $5. So that is the premium that needs to be adjusted when you're trying to find out your P&L, your profit or loss. So what you do is you raise this graph by $5. So you would say, well, at 110, my net income on this strategy is $10 as far as the underlying value is concerned, and another $5 on account of the premium that I received. So my maximum profit gets capped at $15. So on account of a covered call strategy, your upsides are limited, your downsides are still unlimited, right? But still, it might turn out to be a good strategy, especially when your stock, let's say, remains within a certain range. Let's say from 100 to 115 on the upside, and on the downside, let's say 1995. Then you think maybe that's a good option to be in. That's a good strategy to be in. Next strategy, protective put. And what's a protective put strategy? I'm long the underlying, and then I go and buy puts of the same underlying. So unlike a covered call where you receive a premium, here you need to pay a premium because you're buying a put on the underlying. So I own the underlying, so I'm buying shares of the same stock, and at the same time I buy enough put options to cover those shares. right? So I'm long the underlying as well as I'm long the put options on the underlying. So what the payoffs are going to look like? Well, this is a protective put strategy, P plus S, right? So what would it look like? Let's set up the payoffs of a put strategy. I'm long the underlying, so I bought the stock at 100. This is what it looks like. But at the same time, what I did was I bought a put for this option. What's a payoff of a put option looks like? Well, the payoff of a put option looks like this. Let's say I bought a 100 strike price call, 100 strike price put. This is what the payoff of the put option is going to look like. Now I have not included the premium that I pay. I'll take it later on. So if I could try and combine this graph with this graph, what do I get? This and this combines to give me a flat line out here, and then this and this combines to give me this line. So this is what my graph is going to look like. So below the strike price, well, your losses do get capped, and out here, I mean, it's zero because you bought the stock at 100, and at the same time you bought a put option with the strike price 100. So any decline below 100, there would be a protection coming by way of put. So if I'm losing, let's say at 90, I'm losing 90 rupees on the stock, but I'm losing 10 rupees on the stock. But at 90, I'm gaining 10 as far as the put option is concerned. So my losses are nullified by my gains on put, and hence I get a flat line followed by whatever upside that comes my way by way of the stock possibly moving beyond 100. So this is what your final payoff is going to look like. Now, let's realize I must have paid some money for this option. So let's say I paid 10 bucks for this option. So I pull down this entire graph by 10. Clearly my break-even point is going to be 110 because I spent 10 bucks on the option. Only when the stock goes beyond 110 do I make money which is good enough to recover my cost on the option, right? So this is how your protective put strategy is going to look like. The next strategy, bull call spread. One can create a bull spread by way of a call, so we term it as a bull call spread. You can also create a bull spread by way of a put. How do I create it by way of a call? I buy a call option with low exercise and I sell a call with a higher exercise. So let's say I buy a call with the strike price 40 and I sell a call with the strike price 50. So 40, call 40 has been bought and call 50 has been sold. So this is what I buy, this is what I sell. Now clearly know this option will be priced higher than this option. So maybe I bought it for 5 and this I sold it for 3. So my net option premium outgo is going to be $2, right? Now what is therein for me? Well, any movement beyond 40 will give me money. Why? Thanks to this option. Till the underlying reaches 50. Beyond 50, whatever that I gain on this option is what I would lose on this option. So clearly my gains or my payoff is capped to 10, which is essentially the difference between 40 and 50. So my payoff is capped at 10. The premium that I have paid for it is 2. So if my payoff maximum is 10 and the premium that I have paid is 2, clearly my maximum profit in this case is 8. What can I lose? Well, I can lose in terms of the premium that I have paid for this strategy, which is 2. Doesn't look bad. The maximum gain could be 8, the maximum loss could be 2, clearly, the ratio being 1:4. So bull call spread can look really good, especially if your view plays out. Also remember, a bull spread can also be created by way of a put, and maybe we'll see it going forward. So what is the underlying expectation? I expect the stock to move up beyond 40, but not go too much beyond 50, right? Because if my expectation was that it would go well beyond 50, I would not be selling a 50 strike price call option. So expect this call to be in the money and this call to be out of money or be at money at the time of expiry. So this is how my payoff is going to look like. Simply put, let's extend our example. I'm long a 40 strike price call. So this is what the payoff is going to look like. I'm short a 50 strike price call. This is what the payoff is going to look like for this particular option. I combine these two, so I get this kind of a graph finally. But then I had paid a certain premium for this strategy. How much? Net $2. So I pull it down by $2, thereby indicating that $42 is the break-even point. Correct? So if the stock finally ends up at 42 or more, I end up making some money on these strategies. An example, an investor purchases a call for 3 with a strike price of 40 and sells a call for 1 with the strike price being 50. Compute the payoff of the bull call strategy when the price of the stock is 45. Should not be very, very difficult. Before looking at the solution itself, can we work it out? I think this should be fairly easy, isn't it? Now the stock finally ends up at 45. This call will be valued at 5. This call will be valued at 0. So clearly your payoff being 5. And what had you spent on it? Well, I spent on it net $2 because I bought a call for 3, I sold a call for 1. So by having spent 2 and having made 5, clearly my payoff is 5 and my profit is 3. Right? So the payoff is 5, the profit is 3. Let's look at it. There we see the value of the option, $5, and the value of the option that you wrote is 0. So this gives you a maximum payoff of 5 in this case, minus 2, which is the net premium that you paid. There you have it. Your profit is 3, your payoff is 5. Kindly draw the distinction between the two. Next, bear call spread. Now look at bull call spread. As by way of our example, a bull call spread was when I bought a 40 call and I sold a 50 call. Similarly, when you buy a 50 put and you sell you buy a 40 put and you sell a 50 put, you are creating a bear call spread. So all that you need to do is just replace call with put, and you still have a bear call spread. The next strategy is bear call spread. Before we get into it, let's just quickly look at what if I create a bull spread by way of call. Can I create it by way of a put? Yes, I can, by buying a 40 strike price put and selling a 50 strike price put. I think this is something that we will discuss in the subsequent slide. Let's look at what a bear call spread is. A bear call spread is the sale of a bull call spread. So what I do is, sticking to the same example, I bought a 40 call and I sold a 50 call. That was a bull spread. If I buy a 50 call and I sell a 40 call, that means essentially the other party. So if you bought 40 and you sold 50 to the other party must have bought 50 and sold 40. So the position of the other party is termed as the bear call spread, right? So it's buying a 50 call and it's selling a 40 call. So clearly there will be a net premium inflow as far as this strategy is concerned, and the underlying view being, when I create a bear call spread, the underlying view being that the stock will not rise, rather it will fall, and hence both the options would be out of the money and I will take home the premium that I pocketed, right? So the bear spread trader will purchase the call with a higher exercise price and sell the call with the low exercise price. This strategy is designed to profit from falling stock prices. When the stock prices falls, well, both the calls, the one which you bought and the one which you wrote, both would be out of money, thereby allowing you to take home the premium that you received from it. So out here, the upside will be to the extent of the premium, and the downside will be to the extent of the losses, the negative payoffs on this option, which is minus 10. And let's say you receive the net premium of $3. So you would say, well, your maximum loss would be to the extent of $7. So how do I replicate a bull and a bear spread using puts? Yes, I can. Let's take our example, and I believe This is what I was trying to discuss in previous slide. To a limited extent, I started off with that. You would say I could create a bull spread by going long call 40, going short call 50, or by going long 40 put and by going short 50 put. Then you would say, so what's the difference between the two? The difference being that here net you pay a premium to begin with, and here net you receive a premium to begin with. That's the difference. So here you receive a premium, here you pay a premium. And similarly, a bear spread as well can be arrived at by way of puts, by buying a 50 put and selling a 40 put, or by buying a 50 call and selling a 40 call. There we have it, same points being indicated. You can easily draw the payoffs. Right? So let's take an example. An investor sells a put for 3 with a strike price of 20 and purchases a put for 4.5 with a strike price of 40. Compute the payoff of a bear put spread strategy when the price of the stock finally ends up at 35. Now look at this. I sold a put for 3 with the strike price of 20 and I bought a put for 4.5 with the strike price being 40, right? So I'm long this particular put. So I bought a 40 put and I sold a 20 put. Okay. Now I need to find out the payoff of this strategy. When the price of the stock finally settles at 35. If the stock finally settles at 35, this put would give you 5 and this put would be worthless, thereby allowing you to make a payoff of 5. Now the premium that you had paid net for this is $1.5 because you receive 4.5 and you paid 3, right? You would say your net profit will be 3. There we have it. Fine. Next, butterfly spread. Now what is the butterfly spread? It involves the purchase or sale of 3 different call options. Here the investor buys a call with a low exercise price, buys another call with a higher exercise price, and sells 2 calls with an intermediate exercise price. So let's say I buy a 30 call, I buy a 50 call, and I sell 2 40 calls. That's what a butterfly spread would look like. Now what would be the payoff of the butterfly spread? Well, this is 30, this is 40, this is 50. The payoff of a butterfly spread is going to look like this. That means you make maximum money when the stock finally settles at 40, which is the intermediate strike price. If you look at it carefully, a butterfly spread is just a combination of a bull spread and a bear spread. One can create it by way of a set of 3 calls, or rather 4 calls with 3 strike prices, or a set of 4 puts with 3 different strike prices. So I can go long 30 put, I can go long 50 put, and I can sell 240 puts, and this again gives me a butterfly spread. The buyer of the butterfly spread is essentially betting that the stock will stay near the strike price of the written call. That's where I'm expecting it to stay, and that's where my profits gets maximized. Now what is interesting is that you don't have a negative payoff at any point. So is that too good to be true? Well, what you forget is that there's a certain premium, net premium that you pay for this strategy. So you need to drag it down to that extent. Right? So there is a certain range within you would make money, and below or above this range is when you would lose money to the extent of the premium that you have paid to create this strategy. So this is how it's going to look like. So here we take an example. We buy one call at 7 with the strike price of 55. So the premium that we pay for it is 7. We buy another call with the strike price being 65, and the premium that we paid for it is 2. And we sell 2 calls at 4 each, I believe, with a strike price of 60. So my net premium outgo will be 7 plus 2 minus 2 times 4, which is 1. So that's a maximum that I can lose. So let's try and very quickly draw what the payoffs are going to look like. 55, 60, 65 as discussed. This is how my payoffs is going to look like, and then I drag it down by $1 because that is my net outgo, indicating that I shall at maximum make how much? Is it $5? No, $5 is the payoff maximum at 60. And maximum profit shall be $4, right? With the break-even points being 56 and 64. Compute the payoff when the stock is at 60. Your payoff is going to be 5 when the stock is at 60, but your profits is going to be 4. So there we have the solution. Turns out to be 4. Right? So you can of course use the max functions to get the payoffs of the options, but increasingly you would become more and more comfortable just doing it mentally. The next strategy that we take up for discussion is the calendar spread. Well, this is created by transacting in 2 options that have same strike prices but different maturities. So far we had been looking at options with different strike prices but with the same maturity belonging to the same series. Now we look at options which belong to different maturities but they might have the same strike price. Now that's what a calendar spread would be. So the strategy for a calendar spread is going to be to sell a short dated option. So the near term option is something that you sell and you buy the distant term option. So let's say we are in the month of February. I buy a March series option and I sell a February series option of the same strike price. That would be a calendar spread. Well, when do I profit? If the option remains in a very narrow range, so this option goes almost worthless and I pocket the premium. Effectively, it reduces my cost of the long dated option. Who knows, I will be making money. In reverse calendar spread, I do exactly the opposite. So I short a long dated option and I buy a short dated option. This is how the payoffs are going to look like. Within a certain range, you do make money. The next strategy, diagonal and box spread. So diagonal spread is similar to calendar spread except that instead of using options with the same strike prices, I use options with different strike prices. So to that extent, it's slightly more complicated. You have options across 2 different maturities and 2 different strike prices. A box spread is a combination of bull call spread and a bear put spread. So this strategy will produce constant payoffs that is equal to high exercise price minus the low exercise price. Under no arbitrage assumption, the present value of the option is equal to the net premium paid. So I'm long call, short call. At the same time, I'm long put, short put. Right? So it's a combination of the bull and the bear spread. And you would see that if I'm long, let's say if I'm long call 40 and I'm short call 50, and at the same time I'm long put 50 and short put 40. You make money irrespective of where the stock prices are, right? And this $10 spread is a short. Given that it's a sure and certain payoff that you are settling for, well, this can't be anything but a riskless return. So clearly the premium that you pay to create this strategy will be the discounted value of $10. So when the profit from box spread strategy is different than zero, so clearly what we are trying to say is when you are looking to make some return, some payoffs in excess of where the difference between the payoff and the premium is more than the risk-free return, that's when you would go and take a long position in the box spread. And in case if the difference between the payoff and the premium that you're paying for it is lower than the risk-free return, then you can go and short box spread. So when I say the profit is positive, I essentially mean the payoff, the maximum payoff, which is $10 in our case, exceeds the premium beyond the risk-free rate. So that's when you would go long a box spread. Do remember, this is successful only with European options. So there we have a stock trading at USD $100, a box spread with 1 year to expiration, and strikes at $120 and $150 is trading at $20. So there we have the difference between $20 and $50 is $30, and so I can make an assured payoff of $30 by investing $20. So the premium that I would incur to create this strategy is $20, and the maximum payoff and in fact the sure and certain payoff that I would make out of this is $30. So $30 payoff on a $20 return over 1 year doesn't look bad, but then we don't know what the prevailing interest rates are. So the price of the 1 year European call option with strike price 120 is USD5, and the price of a European put option with the same strike price and expiration is USD25. Now, what strategy exploits an arbitrage opportunity, Fanny? Now, here we are looking to see if there's an arbitrage opportunity. Now, we would be able to identify an arbitrage opportunity in the box spread had been indicated the risk-free rate. That means the rate at which I can raise money, right? Because I would be spending $20 to create this strategy, and I would be creating a payoff of $30 for me. So my investment is going to be $20, and my net payoff is going to be $30. But when I make an investment of $20, I would say that an assured payoff of $30 would result in arbitrage profit only if the difference between the two is much more than what the risk-free rate is, or is much more than the rate at which I'm arranging my money, right? So if this $20 is being arranged at, let's say, 100% interest rate, I'm just taking it theoretically, then you would, at the end of the year, you would pay $20 plus another $20 of interest, which well exceeds your payoff, correct? So that's the point I'm trying to make. Can I raise $20 at a rate low enough for me to make some money net on this strategy? Now let's look at how the put call parity would pan out. Now we know that the put call parity is C plus X into e to the power minus RT is equal to P plus S, correct? Now put is being indicated at 25, stock currently is trading at 100, my call is trading at 5, impliedly telling me that the present value of a bond, please remember, the present value of a bond having a redemption value of strike price, and the strike price out here is 120 that we are talking about. right? This is the value of the bond, present value of the bond, which will finally give you $120. Now, this, it seems, by way of this put call parity, turns out to be 120. You can look at it. 5 plus 120 is equal to 20. That means the value of a bond, a value of a zero coupon bond with the face value $120, and mind it, it's a 1-year bond, currently is $120. So what is the implied interest rate? It's 0%. That means somebody can issue this bond and raise money at 0%. Now, how do I create this synthetic bond? Right? Because when I say I want to issue a bond, that means I want to go short a bond, right? How do I short a bond? Well, you would see that if I take P plus S minus C, that is equal to a bond. So if I want to short a bond, that means you take a negative sign. This would mean minus P plus S plus C, right? So for me to create this strategy, P plus S, sorry, this is P plus S minus C. And for me to create a short position in the bond, in other words, raise money at 0% interest rate, would mean going short a put, going short a stock, and going long a call. Minus P minus S plus C. That's equivalent to having taken a short position in the bond. That means I can raise $120 by selling a put for $25. That's what I'll get by selling a put. I'll get another $100 by selling the stock, and I will buy a call which will incur $5. So there I have, this is an outflow. Net, it gives you $120. This is almost equivalent to having issued a synthetic bond, and that too at 0%. So by doing this, I arrange $120, which in turn can help me create 6 such box spreads, because every box spread costs me $20. So with $120, I can create 6 such boxes. So thereby, with $120 investment, and that too, I've raised this money at 0%, I'll be able to generate 180, because for every 20, I generate 30. So for every 120, I'll generate 180, 6 boxes. Then at the end of the year, impliedly, I will redeem back my $120 and I will be left with net 60. That's clearly an arbitrage profit. So what is it that you are going to do? So there you have the 4 options. Try and match. We talked about going short put and going short stock. So short 1 put, short 1 stock, buy 1 call, and buy 6 units of box spread. So clearly looks to be the first option.
Next topic, combination strategies which are involved in options, which we can create out of options. So we'll start off with a long straddle. Now, how do we create a long straddle? Well, we can do so by purchasing a call as well as a put with the same strike price and expiry period. So I go long call as well as long put with the same strike price, with the same underlying and the same expiry. Now, what is the idea behind taking a long position? We realize that call would give me money if the price were to go up, and go up much more than the premium that I pay for it, and put is something that I buy when I believe that the price is going to go down and much more than the premium that I have paid for it. So imagine if I were to buy put and call at the same time, more likely than not, I have a view that either the prices are going to go up or down, and go up or down by such a wide margin that it will help me recover all my premium costs. So clearly it's a bet on volatility. A short straddle is a bet against volatility, so I don't mind selling both puts and calls, with the idea being that my premium is good enough for me to cover up for all the potential losses that can kick in on account of having taken a short position. So that's clearly a bet against volatility. Strangle is very similar to straddle, except for the fact that it's a little less expensive strategy, because you are dealing with out of the money call and out of the money put. So what would a long straddle payoff diagram look like? Doesn't surprise me. 200 strike price call that I buy would tend to give me a payoff on the upside. A 200 put strike price would give me a payoff on the downside. So I make money on either moves, but there's a certain premium that I have paid, and hence I try and drag down my payoff diagram to that extent, so which gives me the payoff, which gives me the P&L. So you clearly realize that there's a certain range where you would end up making losses, and only if the prices were to go up beyond this level or were to go down below this level, that's when you would start making money on this strategy. So clearly it's a bet on volatility. So we take an example. An investor purchases a call on a stock with an exercise price of 50 and a premium of 1.5. At the same time, he purchases a put option with the same maturity that has an exercise price of 45 and a premium of 2. So that doesn't look like a straddle. It looks more like a strangle. Compute the payoffs of a strangle strategy if the stock is at 40. So we clearly looking at the strike prices 50 and 45. So I buy a call as well as a put. Since I'm buying it at 45, it doesn't seem like out of the money. It's clearly in the money. So my profit is going to be 1.5, given that the stock finally ends up at 40. Yeah, I think that's what the question is. So if the stock finally ends up at 40, what is the money that you're making or losing? Well, think of it. I think the best way to understand and figure out what is the money that I'm making, well, you look at what is the value that your call position is assuming, and what is the value that your put position is assuming. Now the call ends up out of money, the put ends up in the money. So 0 plus 5 gives you 5, and the total premium that you have incurred on assuming the two positions is 3.5. So your net profit is 1.5. There we have it. Strips and straps. Clearly ratio strategies. A strip involves purchasing 2 put options and 1 call with the same strike price and expiration. So clearly there is a bias towards the downsides. So a strip is betting on the volatility, but is a little more biased towards the downside, a little more bearish. Strap involves purchasing 2 call options and 1 put with the same strike. So again, a bet on volatility, but slightly on the bullish side. Next, collar strategy, very, very important. A collar is a combination of protective put and covered call. In other words, I happen to have the underlying, I go and buy a put, and at the same time I sell a call. Well, this would result in limited upsides, but at the same time limited downsides. And given that I'm buying the put and selling a call, in terms of premium outgo, it might not be much, or almost a neutral strategy in that sense, a neutral cost strategy. So the usual goal is to buy a protective put and finance it by selling a call. Generally, collars are created with respect to interest rate exposures. So an interest rate cap is an agreement in which one party agrees to pay the other at regular intervals over a certain period of time when benchmark rates exceed the strike rate. So I have an exposure to interest rate liability, and the interest rates that I pay are essentially floating, but then there is a cap as well as a floor built in, which is nothing but having gone long on interest rate calls and having gone short on interest rate puts. So I pay the minimum rate when the benchmark rates go below the strike rate, and hence my cost doesn't really go below the strike rate. But at the same time, since I'm buying a call, my effective cost doesn't go up beyond the strike rate. And the two strike rates are the caps and the floors that I'm creating for myself. So that's clearly an interest rate collar. It would be interesting to compare options on rates with options on prices. I mean, they behave exactly opposite. A value of a call on LIBOR, realize guys, is having the underlying in terms of interest rates, and hence would give you money when interest rates are rising. In other words, when the bond prices are declining, that's when a value of a call on LIBOR will give you money, right? So if I have a bond, I could very well hedge it by buying a call on LIBOR. Similarly, a value of a call on bond price would have bond as the underlying, and hence the call value will go down when the prices are declining. In other words, the rates are increasing. So a value of call on LIBOR and the value of call on bond, they will behave exactly opposite to each other. And similarly, a value of put on LIBOR and the value of put on bond price again would behave very, very differently, exactly opposite to each other. And I think this table in itself is quite self-explanatory. You might just want to spend a couple of seconds on this table. Try and remember, I think, the first two, and then I think everything else falls in place. And when you remember this and you remember this, this clearly could be derived from this, and so could this. There we have it. Interest rate collar. Interest rate collar is a simultaneous position in a floor and a cap on the same benchmark rate over the same period with the same settlement dates. The first type of the collar is to purchase a cap and sell a floor. So I buy an interest rate call and I sell an interest rate put when I have an exposure to a floating loan. The second type of a collar is to purchase a floor and sell a cap, and that's what I would do if I have an interest rate asset to begin with. So let's take up a few questions. Which amongst the four trading strategies limit investors' upside potential and downside risk? Long position in a put combined with a long position in the stock. Not very sure whether it really caps my upside. It doesn't, right? A short position in a put combined with a short position in the stock. Again, it doesn't, because when I take a short position in the stock, a good way to hedge is to buy a call, but that's not what I'm doing. I'm buying a short position in put. Buying a call option on stock with a certain strike price and selling a call option on the same stock with a higher strike price and the same expiration date. Clearly, your risk is to the extent of the premium that you have paid, and your upsides are, and your payoff is limited to the extent of the difference between the strike price of these calls. Well, this is clearly a bull spread. Buying a call and put with the same strike price and expiration date, you have upside, unlimited upside potential and unlimited downside potential. So there we have the answer. 3, because all the remaining, the first, second, and the fourth, either you are creating unlimited upsides on either sides, or at least on one of the sides you are keeping yourself unbound in terms of exposure. So a bull spread clearly limits your upsides as well as your downside. Next example. An investor sells a June call of ABC Limited with strike price of 45 for 3 and buys a June call with a strike price of 40 for 5. Okay. What is the name of the strategy and the maximum profit and loss investor can incur? So I'm buying a 40 call and I'm selling a 45 call. Clearly it's a bull spread, and my payoff, maximum payoff, is the extent of the difference of the two strike rates, which is around 5 rupees, and hence $5, and hence my maximum payoff or maximum profit will be my maximum payoff minus the premium that I have paid for this strategy. The premium that I have paid for this strategy is 5 minus 3, which is 2. So $3 would be my maximum profit. Full spread. So the cost of the strategy is $2 and the maximum profit would be $3, and that's when the stock price reaches 45 on the upsides. Next example. Which of the following strategies creates calendar spread? Sell a call option with a certain strike price and buy a longer maturity call option with the same strike price. Okay. Buy a call option with a certain strike price and buy a longer maturity call option with the same strike price. Now, when we talk about calendar spread, clearly we are going to take one long and one short position in the same option. So it can't really be two. Sell a call option with a certain strike price and buy a shorter maturity call option with the same strike price. Buy a call option with a certain strike price and sell a longer maturity call option with the same strike price. So, we need to know what calendar spread is. Selling a call option with a certain strike price and buying a longer maturity call option with the same strike price would create a calendar spread. Now, in a calendar spread, we aren't really playing with the strike rates. We are playing with the maturity. So your strike rates has to be similar, and it's just that the maturities have to be different. So you go short the shorter end of the maturity and you go long the longer end of the maturity. So I'll buy a March, I'll sell a March series and I'll buy the April series, right, with the same strike price. That's what a calendar spread would be. Let's take another example. A portfolio manager wants to hedge his bond portfolio against change in interest rate. He intends to buy a put option with the strike price below the current price in order to protect against rising interest rates. Okay, and he also wants to sell a call option with the strike price above the portfolio's current price in order to reduce the cost of buying the option. What strategy is the manager using? Well, that looks like a collar strategy. A collar strategy limits the changes in the portfolio value in either direction, and hence it's a combination of protective put and covered call. So I might be having a bond portfolio. I go ahead and buy a put with the underlying as bond, and I go and sell a call again with the underlying as bond. So that limits my upsides as well as the downsides.
Apna Course. Get smart. Get ahead.